Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
So thanks everybody for joining us, our episode number 10. And for those who are new, we like to keep this very interactive. We want to keep it as close as a live meetup as possible. So we have a few questions that we prepare for Shane, but the goal here is for everybody to ask questions, and anything you want to know about how Shane got started, he'll introduce himself in a second. But the goal is, how can you get from 0 to 1? How can you get into your first syndication if you have not syndicated before, or if you have, how can you get to the next one and how you can get better? So every week we're trying to learn from each other and growing as syndicators.
Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice.
So my name is Marcelo. Thanks again, everybody, for joining. My background is in IT. I have 25 years of IT and management experience, an MBA from Texas A&M. I'm also a certified project manager. And I'm a local CCIM member here. I completed all the CCIM designation trainings. I'm a multifamily investor, and I also own and operate my own commercial real estate. And prior to multifamily, I was involved with single family fix and flips. And Claudia and Martin.
Well, this is Claudia and Martin Rubio. We are commercial real estate investors, and we're based out of Houston. And I am a real estate professional, and I have a degree in architecture, and my background in asset management is in Colombia, where I was born, in South America. Mostly of managing my assets and the ones I inherited from my parents, and then ours when we got married. And currently, we manage. We're doing the asset management of our first syndication, and I'm also holding an IROP certificate, a National Apartment Association IROP certification.
I'm an IT security consultant. I've been doing that for over 25 years. Recently, we started with multifamily. We've been, as Claudia mentioned, we've been related to real estate some way or another all our life, but we started with multifamily around 2 years ago, and we closed on our first syndication that Claudia mentioned last December here in Houston. We are partners in almost 800 units, passively and including the sponsorship in different markets here in Texas and in Arkansas. And that's it.
All right, thanks guys. Shane, do you want to go ahead and introduce yourself?
Sure. First and foremost, glad to see a lot of people on the line, and I hope everyone is, safe and healthy with, everything that's going on. I'm really grateful to be here. Thanks to Claudia, Martin, and Marcelo for having me. In terms of background, so I'm born and raised in Toronto, Canada. Lived there my entire life. I've got a bachelor's of mathematics degree and a master's of accounting degree from the University of Waterloo. I'm a trained CPA, or chartered accountant as they call it in Canada. I spent most of my career in consulting though. From the real estate side, I started investing in single family in 2010 in Canada, not knowing a lot, but knew I always had the real estate bug. I transitioned to the US in 2010, and then I transitioned to multifamily in 2015. And so since then, it's been a great journey. Obviously there's been some ups and downs, and I'm excited to kind of share some of that with you guys today. I'm the co-founder of Catalyst Equity Partners. And so as a sponsor, we've done 4 deals, over 700 units, valued at over $60 million, primarily in Dallas and Houston. I'm based out of Houston. We moved here from Chicago 3 years ago, with my wife, and I've got, 3 young daughters. So happy to be here. And like Marcelo said, let's make this as interactive as possible. Happy to answer questions.
All right, thanks, Shane. So I'll let an opportunity if anybody wants to introduce yourself. spend 30 seconds saying where you're from, what's your real estate experience before we start into asking some questions for Shane. I'll open the floor if anybody wants to do that. So again, you can raise your hand, or you can just go ahead and introduce yourself.
Okay, so it's Jorge and Laura. We're originally from Colombia, South America, from Bogota. I am a CPA. Laura's a real estate agent. I've worked in consulting, kind of like Shane has, and Laura has a background in communications. We did a flip. We saw a presentation by Anthony Chara. We liked it a lot, and then we were working on being passive investors in our first multifamily project, probably happening by the end of the month. So nice to meet everybody.
All right. Anybody else want to introduce themselves? Go ahead, Anand.
Hey, I'm Anand Dugar. I know some of you on here, and I'm new to the multifamily world. I've done one single family investment. I'm looking to get into syndication or doing a TIC this year. And I've invested passively in 3 deals last year, and part of the Brad Sumrock training group.
All right. Welcome.
Thank you.
All right, Andy.
Hey, let's see. I recently just joined Brad Sumrock's personal mentoring program through the recent R&R. I haven't done anything yet, so I'm pretty brand new to everything. I got introduced to Sumrock program through a friend of a friend, and I went to R&R, and so got enlightened there, I guess. But yeah, definitely looking forward to being part of the syndication groups.
All right, perfect. Anybody else wants to introduce themselves? All right, so I'm gonna just, before we do a question, I just wanna know if you can, what's your experience in real estate? So if you can answer the poll here, if you're new, if you're a single family landlord, if you're a passive investor, if you are already a lead and syndicator. This is anonymous answering. We're not collecting anything. We just want to share how many attendees we have and what they experience. I'm just gonna give everybody a minute to answer.
Is the deal still valid? I mean, I was told that we'd get Shane's autograph if we attended. So, I mean, is that still going on, or?
Yes, I'm sure he'll be happy to do that, right, Shane?
Absolutely. It may take a while to get there.
It may have to be a virtual autograph for now.
Yeah, exactly. Virtual high five.
All right, so let me end here. I think we got a lot of responses. So it looks, and let me share the results. So it looks like there's a few that are brand new to real estate. So welcome. Hopefully you guys get some value. And again, if we are talking about something you don't understand, feel free to, we're happy to go back to basics. And we have some large number of single family landlords and passive investors, and some who are already syndicated. So that's awesome. All right, so with that, we're just gonna go ahead and Claudia, you have some initial questions for Shane there?
Yes. So Shane, tell us a little bit more, what were you doing before starting doing real estate?
Sure, yeah, so I'm sure like many of you, I kind of, grew up in a family where it was like, hey, education first, get a job, right? And I did all that, right? I went to school, you saw my degrees. I worked for PricewaterhouseCoopers for 10 years. So, I started off, I'm a trained CPA, did, audit and taxation for a few years. And then I really, realized that wasn't for me. I really wanted to help clients and whatnot. And so I moved into consulting, more management consulting, and I was still working in the accounting space. So essentially I was helping CFOs, chief financial officers, with process improvements, system implementations. I ran pretty large teams, at large companies like AT&T and Verizon. They were my clients. And so, I did that. I lived in Chicago, worked hard, kind of put my head down, and, I went up the ranks, if you will. But, one of the things, as you may know, in consulting is you travel a lot. And so, I got to a point where I was a senior manager, and, we had just got married, and, I had one kid on the way, and I just, looked at, the partners that I worked for, and, they, had great, incomes, and, we're making good money and whatnot. And honestly, I enjoyed what I did. But I saw their lifestyle, and I just, I was at a fork in the road. I knew that, if I had kind of gone to director and moved up the chain, it would be a higher opportunity cost. So, at that point in time, I just decided, hey, there has to be something else. And, throughout that time, this was like 2015, I just realized that my single family in Canada, the market had done quite well. It didn't really have a, 2008 recession like we did in the US. And I've always had an interest in real estate, even though being a finance guy, is really tangible. So then I just kind of slowly transitioned into multifamily. But yeah, majority of my working career was in consulting, project management, large scale kind of project execution.
So you didn't do any single family or other kind of real estate investment before?
So I actually did. I bought some single family homes and condos in Toronto, actually right out of college. I really didn't know anything, and, it was kind of one of those, you just kind of start, taking some action. But, for me, I had some family members in real estate. I knew that, that was a good way to build wealth. And at that point in time, I said, I had my own capital. I could not fathom, larger apartment complexes or even, having investors. So I started off small and kind of, bought one property, bought another, rented it out, went through all the challenges of single family. Don't get me wrong, it's very possible to be very successful in single family, but, I had moved to the US and, I had a small portfolio, and then, I was like asking my father and my brother to help me out. I wasn't willing to pay property management and stuff like that. So, it worked out well for me. I think, it kind of just took some action. Obviously there's a little bit of luck in everything you do in life. But, it took some action, and then, but yeah, that's my start, was in single family real estate.
And how did you find out about multifamily?
So for me, in 2014, 2015, when I was thinking about, how do I get back into, how do I generate some more passive income, right? So I'm not dependent on my job. And, the real estate was doing good single family wise, but, 4 or 5 homes is not going to replace, a fairly good salary, right? And so I looked at, what I enjoyed doing, and I enjoyed real estate. I always followed up on the latest trends and whatnot. And then I realized that, multifamily was based on income. The valuations were based on income, right? So I kind of, that really struck a chord with me, in the sense that, being from finance and, and whatnot, being able to control more than single family, right, is really what struck a chord with me. And, from that point in time, I kind of researched more about what multifamily was. Greater than 5 units, you get a commercial loan. And so I started researching more and more at that point in time. And I knew that, hey, you know what, maybe I could get into multifamily. But in 2014, 2015, my mindset was just to continue to build passive income, but to control it, right? I did not, at that point in time, 4 or 5 years ago, think about building a business, getting into syndication. I had no idea what syndication even was at that point in time.
So besides the valuation, what else attracted you from multifamily?
I think the fact is, I got into real estate because at the end of the day, folks need a place to live, right? It was if you look at folks that were really successful in other businesses, they, most, wealthy people have some type of real estate, right? So I just kind of looked at, okay, what was the type of real estate that they owned, right? And most of it always, came into commercial real estate, whether it was triple net leases, apartments, etc. And so that's, that kind of gave me a little bit of a path to go that way. I also had some family members that were doing small multifamily in Canada. And so when I was a kid, I kind of, and I kind of saw them grow and be successful. So, all those little things and those, the challenges that I had in single family and the realization that I could probably hire a management company, albeit now, we're doing 100, 200 units. Back then, I was still considering buying a 20, 25 unit and hiring some staff to have the scale, the economies of scale, the ability for me, not to be the person that's collecting the rent, trying to coordinate the maintenance, et cetera.
Yeah, that's excellent. So Shane, let me ask you this. Like for a lot of people here starting and how you once started having a full-time job, a family, kids, what kind of changes in your life you felt you had to do in order to really get started as a syndicator?
Yeah, so that's a good question. I mean, I think, really in the beginning, everything kind of starts with mindset, right? And so, for me, I knew that, if I did not do something, I would be following the path of the partners and that would be my life, right? And that wasn't an option for me. So, I really just started getting the education, right? So I knew I needed to make a change. I thought it was going to be apartments and multifamily. I thought it was going to be at a smaller scale. But then, I had to get the education, right? And I was working a full-time job, traveling, across the country every single week. So I spent, evenings and weekends and mornings, kind of reading up on this stuff, and kind of at that point in time, there, the webinars and podcasts and, the bigger pockets of the world weren't as prevalent as it is now. And so I would go to a lot of events and whatnot and just try to surround myself with, with like-minded people. But quite honestly, at that point in time, I was, a lot younger then, and I think a little naive. And I was like, what, I did single family without help. And, so my journey kind of started a little differently. I spent most of my, the beginning trying to figure it out myself, right? So reading books and, I did a lot of what I do now, like building relationships with brokers, building a model, all these things, but I was doing it on my own, trying to just figure it out, right? I was like, hey, I think I'm a relatively smart guy, I have some common sense. But you realize that, once you get into the commercial real estate side of things, it's an unfair business, right? And I learned that the hard way because I spent, the good portion of 8-9 months, just kind of, going at it alone, and I would be going to real estate events, but I would kind of be the odd guy in the room because I would be going to events where there was a lot of single family folks. And, I realized that, over time I had to position myself or align myself with people that were doing what I wanted to do.
Makes sense. And what were you mentioned books and podcasts. What were your main sources of education to learn the business?
It was, honestly, I started off with bigger pockets at that time, right? 2014, 2013, there was a lot of good content being created there, even though it was a more single family focused. There were some multifamily guys out there, a few books on kind of, how to buy an apartment building. I don't have the book off the top of my name. I think, there's a lot of better books out there now. And just did pretty much everything online. And then, started reaching out to some folks that had done, small multis. And, I started building my criteria, just like what you do in whether it's real estate, multifamily, whether you want to start any business, you kind of have to, outlay or articulate what you're trying to do, set some goals, have some criteria. And so, I spent, a good portion of a couple of weeks just writing down my business plan, right? Like I knew I wanted to own X amount of units by a certain point in time. And, this was my high level criteria. This is the capital that I had. This is what I think I could buy. And slowly, once you start building relationships, one relationship leads to the other, right? You get started talking to, this was all in Chicago. So when I started this journey, I was living in Chicago. I was working with, brokers in Chicago and saying, hey, I want to buy a 20 unit, and whatnot. And then they would introduce me to folks like property managers and then to attorneys, et cetera, right? So you're, as you grow and as you take action, your relationships build, you go on referrals. But to answer your question, it was really, online, bigger pockets, a bunch of blogs, anything that I could get myself around to. I read Ken McElroy's ABCs of real estate. So that really struck another chord. Read Rich Dad, Poor Dad. in 2010, that's how I kind of got into single family, et cetera. But, kind of one thing was just a building block to the next.
So just to clarify something you mentioned there, Shane, Jorge was asking that, can you expand on your comment about the business being unfair on commercial real estate, and how do we play the unfair game?
Yeah. So what I mean by that is, obviously there's higher barriers to entry in commercial real estate, but I think, what I'll say is I'll start with on the single family side. A lot of us become, real estate investors by becoming accidental landlords, right? You buy a house, you realize, hey, you need to upgrade or you need to move for whatever reason, and you're just going to rent that out, right? And so typically, most people in single family, they start off, kind of with their own capital. And, nowadays there's so much technology out there that, you could really buy deals without even using a broker, et cetera. And you don't have as much to lose, right? There's a lot of supply. There's not as many brokers that focus on just single family investors, right? So the way that you go buy a house, to live in is very similar to how you buy, a single family home. Obviously you want to run your models and stuff like that, but the barriers to entry are a lot lower. And then, even if you, so now taking it, kind of on the other side, commercial real estate, even if you had the money, to go and buy a 100-unit, property, right? So say if you had, $2-3 million, it's a $10 million deal, you bring 20 or 30% of the money, it would still be harder for you without experience, or at least a network around you with experience, because, brokers in that business, in this business, focus, primarily on one asset class, right? And they only get paid when the deal closes, right? And so, if, there's a lot of moving pieces, obviously it's not a complex business in, when you think about it, it's bricks and sticks, residents, and a community, but there's a lot of moving pieces that all have to work together in cohesion, right? So, brokers really, if it's your first time, they're really, if they don't have to, they're not going to take a chance on you, right? And so, and I felt that, when I moved to Houston, I was educated, I joined a group and stuff like that, but I had not done a deal before. I'd done, single family and whatnot, but they want to know, have you closed? And so that's what I mean by it's an unfair business, right? And there's ways, right? And well, I'm sure we'll talk about to, get around that hurdle, right? And so, that's the reality. You got to put yourself in the shoes of the broker. And, I would say 90% of the deals that we do are primarily through brokers. It's not like single family where there's a lot of wholesalers. You could go direct to owner and stuff like that. You're dealing with properties that are 5, 10, 15, $20 million. And, typically they're, and in this day and age, they're pretty sophisticated owners that own it. So hopefully that answers the question in terms of it being an unfair business.
Yeah, I wanted to add. So I always try to, when new people ask me about how this business works and where the unfairness comes from, I always try to talk about strategy, right? Every one of us, when we get presented all this information, we have to formulate what's our strategy. And that strategy for me usually has 3 buckets. One bucket is of the stuff I need, what I have right now, of the stuff I need, what I don't have and I can build. So for example, for us, when we started was, for example, investors. We didn't know anyone. We were brand new on this space. So our strategy was, we're going to go to every single meetup. We're going to meet a lot of people. We're going to put the time into it. And the third bucket is what you don't have and you cannot build. So for that one, you're going to have to find partners, right? And that's not only on getting investors, or it's for every single part of the business. Like Shane was mentioning, brokers, lenders, property managers, all of those, you need to figure out which bucket those are in. And usually the unfairness comes from you miscalculating where one of those fits in which bucket, and you put it on the wrong one. So you have to take some time to educate yourself to understand where everything fits and to make sure your strategy is actually effective. So the next question for Shane was actually oriented towards strategy. We always talk about how important is your team for going after these properties. As I was mentioning, lenders, property managers, brokers, investors, all of those. So when you put together your team the first time for your first property, you didn't have a lot of experience. Did you have any specific strategy on how that team was put together? Any specific tips you would give someone?
Yeah. I mean, I think maybe before, talking about specifically the team, right? Like the first thing is you got to get the education, right? Because, without, having the education, knowing the lingo, you're not going to build any credibility with brokers or investors or lenders or property management companies, right? So the one resource that's all, that we all have, that we share is time, right? And that's very valuable. So, I mean, the first thing I did, and this was kind of, by accident, as I, going back to my experience in 8 months trying to figure it out myself, that didn't work out. And then I stumbled across, syndication, and there was some multifamily mentoring, went to a few different groups. And then, I joined, Brad Summerrock's group in 2015. He's a multifamily mentor based out of Dallas, but, has a national program. And that was really when the light bulb went off, right? Because, I saw folks that I met there, that, were regular people, professionals that were doing deals, 100, 150 units. And, previously I couldn't even imagine doing that type of deal. I thought it was owned by, the Blackstones of the world, the larger REITs and whatnot. And so that was my kind of way to get the education, right? And then understand syndication. And then from there, I realized, I need to, figure out what my criteria is, right? And then, obviously there's a lot of different schools of thought out there. We focus on Class C and B space, primarily in the value add space. And then, really look at, the different pieces that you've got to put together. And you get that education from, I got it through the mentoring group, but, property managers, et cetera. And I wanted to make sure that I aligned myself with people that had done it before, right? So, one of the things that I tell, most new folks is, this is a long journey, right? I mean, and it, you have to start, even if you plan to syndicate in 6 months or 12 months or 18 months, you got to start now, right? Because, I was working with investors for probably 2 years prior to me even, presenting an offering to invest, right? So people got to know me, et cetera, right? And so you got to kind of start planting those seeds early. And then, for example, like I knew with my track record, it was going to be really hard for me to do a greater than 100 unit deal. So I met, certain sponsors and people that had done, several deals prior to, historically. And our first deal, we partnered with someone that at that time had done, 20 multifamily deals, right? So, he was a partner with us, and I say us because I have a formal business partner. We started at the same time, but then that, third experienced partner, his track record, right, really helped get us credibility with the broker, right? But yeah, I mean, really, if you want to talk high level, the key pieces as a syndicator or a newly formed syndicator, is really, you got to have your partners. You could do it yourself, but, I would recommend partners because of what I just said with track record, your lender, right? Because, in this space, the lender is your biggest partner. They're bringing, depending on, the economy and whatnot, 65 to 80% of the money. And, then you got your investors, right? So you need your passive investors, you need your property management company, and then your attorney, right? I would say, those kind of 4 buckets are probably what you need to focus on initially. And then, you'll start, getting more specialized, partners like insurance folks, CPAs, cost seg, contractors, et cetera. But I would focus on, your mentor education first, your lender, your property manager, your attorney. Those are the real keys to start, going in this business, and investors, obviously.
Awesome. So let's say someone that's starting out, they work on that, they get their education, they start putting together their team, and they're ready to go look at properties. Did you focus on a specific market when you started? Would you recommend to do that? Because most people, they start looking all over the place, and what would you recommend?
Yeah. So, I want to take one step back as well, because, so I'd done single family till 2015. I started getting into multifamily, dabbled in it on my own, wasn't successful, found mentorship, but I didn't jump right into syndicating, right? Syndicating was a new world for me. Larger apartments were a new world for me. So I got educated through, obviously just being around people, there's education modules and whatnot. And I started investing passively, right? Because I wanted to, obviously, make my money work for me, but I also wanted to learn from people that had done it before, right? So, I invested in several deals prior to even going out on my own, right? That really honestly helped me. You're not going to get the full under the hood view, if you will, but you get a good perspective on how deals, are put together, how deals sponsors operate, how they, perform post-closing, et cetera. That really kind of gave me a good understanding of, okay, this is how this works as a syndication, right? And then, I learned a lot of things, like I said, I was starting this business in, Chicago, Illinois, right? Which a lot of people know right now, there's a lot of, political issues there, and high state, taxes, it's not landlord friendly at all. People were moving from there left, right, and center. And so, after I got more education, realized that, I need to be in more landlord friendly states, business friendly states, et cetera. And so, we had moved to Houston primarily for, personal reasons, but also for business reasons. And, we kind of, looked at all the demographics and just the data that really supported, Texas. And, there's a lot of other great markets, but being kind of boots on the ground was very important to me, especially for my first deal. And so, I moved to Houston, and, my now business partner's in he lives in Dallas. And so, we focused on these markets, for all the reasons I said, good job growth, population growth, landlord friendly, et cetera. So that was kind of our farm, if you will, initially.
Okay. And then once you had that criteria set and you were looking for properties, how long do you think that took? Like, how many deals do you have to look at? How specialized was that analysis on like underwriting those deals, making sure you were looking for the right one? Yeah,
no, that's a good question. So, I moved to Houston in September 2016. And at that point in time, I had done, a number of passives. I looked at the skill set that I had. I was starting to build a team. I knew that I wanted to be a syndicator. So I made that decision first, right? And I started building out the criteria. And then from there, you really, I always liken it to, and some people will say, hey, my first deal I looked at, I got, but I would say that's the exception, not the rule, right? I mean, this business is, like anything, it's consistency and repetition, right? So you keep shooting the basketball, you shoot the basketball. So I looked at a lot of deals, I was there, I think, time that I committed to becoming a syndicator, right, was about September, October 2016. And by the time I closed my first deal was October 2017. There were challenges there with Hurricane Harvey and stuff like that. But, our deal, we got under contract in June of 2017. And, we had looked at close to 100 deals. I was looking at, 3-4 deals a week, underwriting, giving feedback. I was still traveling at the time for work. So, trying to do tours on Fridays when I was back in town and whatnot. But we looked at, that many deals, and, it really kind of, it's like muscle memory, right? You start getting better and better and better. And so, and even this past year, we looked at over 250 deals, in 2019. And so, that never, really stops. Obviously I've gotten better at funneling and sticking to our criteria, but, we were close to, I think, 90, 95 deals to get our first deal. We offered on, probably 8, 9, 10, something like that. And then number of best and finals and, to get one.
So how long exactly did it take you to get your?
This is an interesting, I guess, story. It was about 7 months to kind of get it under contract. But then we had, as people in Houston know, Hurricane Harvey was in August of 2017. So we had got it under contract in July, but then we had to have a number of extensions and whatnot. And we ended up closing in October. So from the time that I committed to the time that I truly closed was 12 months. By the time I found the deal, you go through, diligence, you make the LOI, that was probably 7 months or so from the time that I started till I got that deal.
Okay.
And looking at your strategy there for getting the first deal, we had a question from Henry. What are perhaps some of the, consider where we are now versus where we were before with the coronavirus, the changes to the economy? Are there certain things as part of your criteria on how you evaluate deals that you were glad that you were doing already, and perhaps certain things that you feel like, okay, now I need to change my criteria based on where we are if you were to look at your next deal?
Yeah, no, that's a good question. I mean, I think, the one thing is, I personally always was a very risk-averse person, right? I'm a CPA kind of by trade, not. And so, I mean, taking, a dollar of other people's money is a huge responsibility, right? And something that I do not take lightly. And so, from my perspective, whether it was my first deal or, a deal that we're going to, try to do post, coronavirus, right? You always got to think about limiting your downside risk, right? Because, in a bull market, a rising tide lifts all boats, right? And so there's just been a lot of, excitement and whatnot. But I always look at my downside risk, right? So, I mean, and what I mean by that is, try not to get into something where, I cannot control most of the variables, right? There's certain things we can't control, right? And like nobody knew, or planned for a coronavirus type event, right? But there are certain things that you can control, right? Where you buy, what type of leverage you take, what type of debt you take out, and so what type of cap rates you buy it and stuff like that. I don't want to get into too many details, but generally, I try to buy real estate at a fair price or at a discount, right? And so, I mean, there's a lot of different schools of thought out there, where people say, oh, cap rate doesn't matter. I would say cap rate does matter, and because it really limits your risk, right? Or not limits, it protects your downside, right? So, if I was comfortable with the downside, then I would move forward, right? But there's certain things now that I've learned from my first deal, to answer the question is, raise more money than you need, right? And, it may dilute your returns a little bit, but, in a downturn, cash is king. And so, our first deal, we went full cycle, we sold that deal. And I learned so many lessons on that deal that, quite honestly, right now it seems like in the multifamily world and, the world in general, there's a lot of panic and fear out there. And, not to say that I'm not concerned. I'm definitely concerned because, I think we all should be, but, I'm not panicking because of those lessons, right? Because now on all our deals, I raise a significant amount of cash upfront for contingencies, right? Try not to take, a lot of leverage. All my deals are fixed rate, non-recourse debt, right? And so, that's the way that I think you always got to mitigate risk. And, whether you're going to be a new syndicator or you're going to be a passive investor, you got to really think about, what's the risk in this deal and has the sponsor articulated it and have they come up with a plan to make you comfortable that, they've mitigated it as best possible. So I could go into more details, in terms of, kind of what I would do differently or what I learned and what I've done, if that would be helpful.
Yeah, sure. Let's expand on the cap rate comment that you mentioned. Jose was asking, is there a minimum cap rate or cash on cash percentage that you look for properties?
Yeah, so, I would say, there's not generally a minimum, right? What I would say is that, the cap rates, as we all know, have been compressing the last, 4, 5, 6 years, right? Generally the way that I look at it is that if the market cap rate is X, I would like to buy at X plus some margin, right? Because that way I've got some built-in equity, right? And, I'm protecting my downside, right? So, right now in DFW, cap rates for C-class deals, around 6% cap rate, right? If I could go in and buy a deal, or maybe even lower, but if I could go in and buy a deal at 6.5, 7, right? That means I'm buying it at a lower price, right? Which reduces my risk. My first deal, it was in a secondary market of Houston, Alvin, Texas. The cap rate at the time, 2017, was probably closer to a 7 for that type of deal. We ended up closing that deal at close to a 9 cap rate, right? So, I mean, those deals are not always going to happen. And, I'm not sitting here saying I'm going to try to always get, 2% more on their existing cap rate. But, I think it all comes down to risk. And for me, I'd like to buy at the current market cap rate or higher, unless there's a true story that can be explained, for something lower.
And was there anything on that first deal? Was there any particular attributes that when you were looking at it that you thought it was the right deal for you, the right first deal?
Yeah, that's a good question. So, it kind of goes back to, you get educated, you build your team, and you build your criteria, right? So at that time, this is 2017, I knew for one thing for sure is that I wanted full-time third-party management, right? And so, there's different rules of thumbs on that, but typically anything above 80 to 100 units is, what you could afford a full-time manager and a full-time maintenance, right? So, we wanted to look at something between 100 and 150 units. At the time, kind of our strike zone in terms of purchase price was $5 to $7 million. And, because we felt comfortable that between me, my partner, and the experienced partner, we could raise, $2 million, right? So that's kind of how we narrowed down, the type of property and size. And then this deal, was in a secondary market of Houston that was growing, had good population growth. It's in Brazoria County, which has, high median income. The property was owned by, more of a mom and pop operator. It was kind of late 70s construction, but it had all the right physical characteristics, right? So it had pitched roof, it had individual hot water heaters, individual HVAC, etc. It was all 2 and 3 bedrooms, so the unit mix was good for families. And so, that, and it was probably a 40-minute drive from my house to get there. And so all those things considered, and this deal had never been renovated. It had not had a interior refresh, and the rents were 20 cents lower per square foot than the market, right? So all those kind of considerations put together, and I was able to get it off market, at a higher than market cap rate, helped me feel like I was protecting, my downside risk, right? We bought that deal at, low to mid 40s a door a couple years ago, right? And now, deals, pre-coronavirus were selling, for $100,000 a door for the same type of property.
Yeah, for sure. So for somebody that's starting now in the current conditions of the market, and maybe if I had asked you this question maybe a month or two ago, it would be a different answer. But what would be your best advice for somebody that's starting now, given the market situation that we are?
Yeah, so I think, and then I don't know who gave this quote. I mean, I think, there's, you don't just wait to buy real estate, you buy real estate and wait. That said, I mean, I think, it's a good time. It's always a good time to get started, right? There's always excuses that we'll have, personally in business to, kind of kick the can down the road. But I would say, right now, especially right now, is you got to be patient, right? I mean, there's there's a lot of uncertainty, right? I mean, I don't know how many people were in business in 2008 versus now. I was starting my working career at that time. So, and I was in Canada, so I can't speak too intelligently about it. But from what I understand, talking to folks, I mean, that downturn, if you will, was, a little bit more gradual than what we're having now, right? This was literally kind of a flip of a light switch. And, literally like, I was, pre, kind of the lockdowns and the shelter in place, the financing was so generous, right? I mean, there was just, it was the money was out there, the investors were hungry for deals. It was very competitive. But literally like a light switch, things just changed, right? And, kind of the credit market started freezing and there's just a lot of uncertainty out there. But I would say get started, get educated, right? Start underwriting deals, practicing, right? I think, your underwriting is going to have to change in the short term. But, I do see, this is going to pass, right? Sooner or later. And, there likely will be some buying opportunities, right? I mean, I think, I started in 2015 and, started investing passively. And, at that time I thought the market was heated, right? And, it just had this bull run. And, every couple months kind of keep asking ourselves, when's this going to stop, right? And, the reality is that eventually, something happens and, who would have thought it was a pandemic? But, I think this is an interesting time. I think it's a good time to sharpen the saw, kind of get prepared, whether you're on the sidelines or not. There's a lot of education out there. There's a lot of people at home right now, right? So, you could either, waste that time or use that time and get ready. But I would say, personally right now, I think there's just too many unknowns, right? And, in business, you want to make decisions, based on, what you control to a certain extent. But right now there's so many things that, 2 weeks ago, to Marcelo's point, I would be able to control better. Right now you can't control it, right? So, but I do think that, there's going to be some opportunities, not in the, in the near future.
And given to what is happening with the Class C and the folks that are more impacted right now with people losing their jobs, one of the questions was, would you be focusing on maybe a higher medium income areas than maybe you were focusing before, or would you change your criteria when looking at income radius for a particular property?
Yeah, so that's a good question. And last week while this was all going on, I was talking to my partner and a lot of our advisors, and who would have thought that the whole premise of workforce housing, right, was the supply and demand imbalance, right? Everyone needs a place to live. Most of our tenants either don't want to buy a home or are not in the position to buy a home, right? But, you shut everything down and the service retail, right? And they can't work, and it really puts a strain in your business. And, you're really thinking like, at that point in time, I was thinking, wow, it would be nice to be a Class A owner right now, right? Because, knowledge workers by and large can work from home with Wi-Fi and computer, right? But, I think, the reality is that, this, I think is going to be, this will pass. Whether it was coronavirus or not, personally, I always looked at good locations. And what I mean by that is higher median incomes, right? So, we've bought deals, C deals, but in B locations, right? We've got, 50,000, 55,000 median income on all the properties that I own now. And I think, hopefully that will help us weather the storm as, we kind of get through this. I think, maybe the B space, there's probably a little bit less risk right now, right? You probably have some of those workers that, have a little bit of a cash cushion, right? And won't be pinched, versus maybe a C-class renter. But I think, this is, something that no one could have prepared for. And I think long term, the case for workforce housing, if you buy right, you capitalize the deal right. I think, there's it's still a good thesis and something that I will continue to invest in good locations.
And going back to the underwriting, do you have any tips or recommendations for a quick analysis? Because you get a lot of deals from brokers. How do you just analyze quickly, or what can you tell us about it?
Yeah, no, so, I think over time you kind of, develop more of a fingertip touch, right? In the beginning, I would encourage everyone to dig deep, right? Get in there, understand the little nuances of deals, right? I mean, if you want to talk, high level, initially I would, I'd probably look at cap rate, right? Like 3-4 years ago, I would say, okay, what's the current T12? What's their ask price? What's the cap rate? If it's even close to the market, maybe I'd pursue, right? That was kind of my first filter. If it met my physical criteria, if it met my location criteria, et cetera, right? I would, typically look at rents, right? So, if, I would say if there was not at least a 10%, kind of opportunity in terms of uplift, it probably is not going to be a deal that fits my model, right? And so those are kind of like the high level things that, I would use. But then, right now, I mean, the reality is that the market's got so competitive, right? Even those rules of thumb like cap rate, 10%, got your 50% EGI or expense ratio, I should say, that stuff worked maybe 2, 3, 4 years ago. Now, no deal, or I should say, prior to this whole coronavirus, I mean, no deal worked at first cut, right? You had to really dig, right? And so, I think by, focusing on your criteria first, that helps you, kind of eliminate the shiny objects, right? Because when I first started, I'll be honest, I mean, I'd say, hey, I'm only going to look at 100 unit plus. Then, hey, this is 75 units. I'll maybe look at it, or I'll only look at this, primary market. But hey, this is kind of on the cusp. I'm going to look at it, and that just wastes time, right? So I think you focus on your criteria, and then once it hits that criteria, and then there's the must-haves, right? Like I have some certain must-haves, like median income, location, etc. And then there's the nice-to-haves, right? If my must-haves are hit, generally, go through, a high-level underwriting in the beginning, right? We just take the total expenses, we take the in-place rents, see what we can do, and then if it starts feeling like we have kind of our criteria, if it starts kind of getting close to our criteria, then we start digging deeper and deeper and deeper, right? And then, now, I mean, we've got a little bit of help, right? So we have some help that folks that, put the, rent rolls and the T12s and format them and stuff like that. So that helps me jump in there and more review. So I'm not spending enough time. But because I did it, I probably underwrote 700-800 deals in the last 2-3 years myself, right? Where I put in the numbers, right? And now I could really know what to look out for and stuff to catch. So hopefully that helps.
So when you go deeper, where do you look for opportunities on reducing expenses and increasing income?
So I'll start with income first, right? So, I think, and what we're going through right now is probably a good case study, right? I mean, I think, rental income, what people pay for rent, right, is what I personally want to focus on more than other income, right? And so when I first started in the business, deals I invested in passively, or, my first couple of deals that we did, it was all about, okay, right now we're getting, this subject property is getting $800 a month. The property next door, same type of property, is getting $900 a month by doing the renovation, right? That was a proven value add, right? And then, there are other income opportunities like, carports, reserve parking, valet trash, amenity fees, all this stuff, right? But that, 2-3 years ago, that was, icing on the cake, right? If we could get it, right, it would be great, but we would not build our pro forma to, assume that we have to get it, right? And then now as things kind of evolved, things got more competitive, these units have been upgraded 3-4 times in the last 10 years, you're starting to see a lot of people kind of banking on other income, right? And some people, they just don't work without other income. And the reality is that, in times like this, we'll see, right? I mean, they may not need a carport or a reserve parking spot that you're charging them $40 for, right? They're going to say, I'll park down the street and I'm going to save $40 a month, right? They may not pay that $50 a month for that enclosed patio, right? They'll just go to the dog park that you likely have, as your amenity, right? So, I think it's time, before this, people were saying, hey, this property's getting it, this property's getting it, et cetera, right? But at the end of the day, look at all of us now, we're spending time inside our homes, right? And I think, that really is the most bang for your buck. If you could do these other income things, great, right? But I think those are the first things that are gonna, you're gonna start seeing a decrease in, as we go through a recession, right? And on the properties I own now, we just bought a deal a couple months ago. We're not doing any value add exterior. I mean, we plan to do, a bunch of carports and stuff like that. That's all on hold right now. I mean, for that matter, right now, we're not doing any type of renovation that's not a life or safety issue. But yeah, that's what I look for on the income side. Expenses side, I think it's tricky, right? Because, you often see folks say, hey, I can reduce expenses, and there's definitely cases where you can, right? But then there's also a point at which you have to ask yourself, how much can I reduce it and not allow the property to suffer, right? And then, sometimes I look at, the deals that I'm buying deals from sophisticated folks, right? That have, 4,000 or 5,000 units, owner, operate, et cetera. if they're having trouble with R&M or and stuff like that, there may be a reason for that, right? So I look at expenses for sure, but I always take it with a grain of salt, right? And luckily right now, like I own, 600 units in a cluster where it's the same submarket and the same type of deals where I have historical data to help me understand how I'm going to run these deals. I know the utility costs, et cetera, right? So, expenses, generally, typically kind of stay steady or increase, right? But, when I see people, trying to cut payroll from, $1,300 to $800, it's really not achievable, right? Or it's not sustainable, right? And so I think you just got to be, as an investor, and don't get me wrong, there's certain times where payroll is just off the charts, where utilities, water, they haven't done a water conservation program, out of state owner, their R&M, is totally high, or they never, had enough capital for the deal, so they're expensing everything, right? So there's certain times where definitely expenses are high, but I think, as an investor, you really gotta, make sure you don't starve a property, and that you can execute on getting those expense reductions. So.
Yeah, that's great point. So now another perhaps coronavirus question in terms of, as you know, today, April 1st, big rent day. If you end up not getting as much of the rent for April and May, are you already considering negotiations with the lenders, the forbearance process that's being in the news lately? What are some of your considerations that you have right now for low and decrease of rent?
Yeah. So obviously this is the hot topic, right? So, I think first and foremost, right, the first thing that we did was, ensure the safety of our residents and our staff, right? Because without, our residents feeling safe and our staff being able to do their jobs, right, we would struggle to do our business, right? And the second thing that we did was we made sure we communicated upfront, right, with our residents, with, hey, we know that, you're going through challenges, and whatnot, but we're here for you, right? We're open. We want to make sure that your concerns are heard, et cetera. We also, got ahead and sent out a note to our investors right away, right? So I think, a lot of things, we just try not to panic, right? We get prepared, and obviously, I can't say that, I was prepared for a coronavirus type of event, but, I think, the one thing, my first deal, I went through, some challenges on that deal operating wise, right? And that was in a good market. 2017, 2018, we had property management issues. I had to fire 2 property management companies in 9 months, right? And that's not easy stuff to do. We had to drop our occupancy down to 70%, physical occupancy, et cetera, right? So, I kind of learned those lessons, and I've implemented that in all the deals that I've bought since. And so, when this was happening, right, honestly, I was just like, yeah, we could have decrease in rents this coming month, next month. But, what can we do on our end to prepare, right? So we sent out the communication, we let residents know that, hey, different, government programs out there to help you as residents, right? We understand, the challenges that you may have, right? So we try to get ahead of it, right? So we thought of incentives to not renew, leases at a premium, right? We said, hey, for the next, 60 to 90 days, you could renew at your current rents, right? We went out and we sent out a notice to say, hey, whoever pays by the 3rd, right, when rent is due, right, we've got a bunch of gift cards that we're going to send for like $300 gift cards to multiple people to get into a raffle, right? For, Walmart gift cards and stuff like that to incentivize them to pay. We made sure that, we're only focused on emergency work orders, et cetera, right? And so, I guess, to go back to your question about forbearance, right? I mean, honestly, I didn't even think about forbearance, in the beginning at all, right? There's a lot of stuff, on the media, social media, et cetera. And I love that we could talk like this. There's a lot of education. But I think, whether you're a passive investor or syndicator, there's good information and there's bad information, right? And so the way that forbearance, was kind of being spoken about initially was like, yeah, it was like, a free lunch, just 3 months, no problem, don't pay, right? And I think, there's a lot of, and as we know now, there's a lot of strings attached with forbearance, right? And so, my mindset now is we're going to control what we can, right? Going back to the lessons I've learned, we've got, significant cash reserves on all my deals. Like on average, I've got 12 months of debt service in cash on all of our deals on average, right? And so, obviously, we're going to see how rents come in, right? Like I actually had a call with my manager today on one of our properties, and we collected the same amount today that we collected on March 1st and February 1st, right? And so we'll see. I mean, there are a few residents that are asking for payment plans and stuff like that, but we're gonna just kind of see where collections shake out, and see what are the right steps, right? But my forbearance in my mind is the last resort, right? There's a lot of different things that we've done. We've said, okay, we've stopped our CapEx, right? Just to conserve cash, right? The other thing that, we not necessarily did just now, I mean, we stopped distributions, right? Because it's the right thing to do, conserve cash. But previously, I always under distributed, right? Even if I had the money, I always held back 15 to 20%, right? And people would ask why not, right? Well, why don't you send it all out? Because it was the prudent thing to do, right? Because right now, investors are happy that we have that cash set aside, and I'm helping them reduce their risk, right? Whereas, I see a lot of folks, in my passive deals and stuff like that, they want to hit their numbers, and sometimes they're over distributing. They might be returning capital. They might be sending you back your CapEx, right? And so I think, having that mindset, coronavirus or not, is always going to do you, good business going forward. And so, yeah, I mean, to answer your question, forbearance, obviously we're looking into it just to understand the concept. But as I understand it right now, unless I absolutely have to, I don't think we're going to go down that road, depending on, how long, this, slowdown and, shelter in place, kind of continues for. So that's my take. I mean, I think there's different schools of thought on that, but, it just, it just kind of, to me, it looks kind of silly that, there's a lot of people kind of screaming forbearance, kind of end of March. Like I just had my best couple of months on a couple of properties, right? We have no idea what April is going to entail. You get into this business, you should be partnering with folks that have liquidity, and like I said, I brought a property down to 70% occupied. Right now, my properties are 95% occupied, 90% economic, right? And so, I think, people are overreacting, panicking. We're putting everything out there, but, forbearance in my mind is kind of a last resort, for all the reasons I just said. So hopefully, and I don't know if we need to, Marcelo, maybe define forbearance for folks.
Sure, go ahead.
Well, yeah, I mean, it's really, just a workout with the lender to say, obviously, if we don't have the rents that we're expected to have now, we may not be able to cover our mortgage, right? So unless you have cash reserves, et cetera, there's only so many months. Like I said, I've got 12 months, sitting aside, but after that, we'd have to fund the property, et cetera. So it's an agreement with the lender to be able to come up with a payment plan, essentially, on that loan. It's not forgiving the loan, right? You still owe the money. This is all debt that is securitized, which means that there's investors that bought these securities, right? And they're expecting yield on their money. So it's just a way to kind of help you, kind of manage the uncertainty as collections may go down. And so yeah.
Perfect.
No, free lunch.
All right. Thank you so much, Shane. I just want to share some additional information here for our folks. So for anybody that's new, we always meet on the first and third Wednesday of every month. So our next one is the April 15th. And for that one, we focus on the passive investors and how to become a better passive investor. And then again, we meet on the first Wednesday, which is going to be May 6th, and again with another edition for syndicators. So always first and third Wednesday of the month, and hopefully everybody signed up on our website so you can know about our future guests, and also we have access to the recordings there. And with that, I want to bring Shane's information again. We really appreciate your insight, Shane. It was always great to hear you talk, and we appreciate you spending some time with us.
Shane, if someone wants to reach out to you, is that the email that you have there? Is that the best option?
Yeah, yep. You could email me, shane@catequity.com. I'm pretty responsive, or you could even text me, 312-618-7841. So, like most of us, we're at home right now, so feel free to reach out. I'm happy to talk shop and, share whatever I've learned and, continue to learn, and wish you all success. And most importantly right now, stay healthy, safe.
Yeah, for sure.
Thank you for watching this week's episode of the Multifamily 0 to 1. Join us live the first and third Wednesday of every month.